Welcome, everyone, to this session, this special session on business dynamism. So we're going to jointly review sort of where the frontier of the literature is, what the open data and evidence gaps are, and sort of how researchers can work with NSIs like the ONS to develop the necessary data infrastructure. We have three excellent panelists today. Sophie Piton from the Bank of England, Sabien Dobbelaere from the University of Amsterdam and Tinbergen, and Javier Miranda from IW Halle and the Friedrich Schiller University Jena. So just to frame the debate very briefly, we all, I guess, in this room are aware that by just about any measure, business dynamism in the UK has fallen. So just to give you one way to quantify this, from the excellent ONS business demography bulletin, the net job reallocation rate in the UK has fallen from about 30% to 20% since the beginning of the millennium, and these trends broadly hold across all industries and essentially all peer countries. So hopefully we'll get into some of the causes, but also what we don't know about these trends. Sophie, do you want
see it there. Oh, here, okay. Oop. Here. Thank you, Jakob, and thank you for also putting this session together. So before I start, let me say that I'm from the Bank of England, so the usual disclaimer applies. And I actually was hoping to present work in progress from the bank, but recent events meant that we had to pause this project, so I'm rather going to present a summary of some work we've been doing so far, and also some avenues for future research. So trying to show what we already know about UK business dynamism, but also what we don't know, and what exciting data could we use to learn more and do future research to help build a picture in the UK. So most of you in the room, if you're familiar with business dynamism literature, will have in mind the secular decline that actually Jakob just mentioned, secular decline in business dynamism. But there I will be a bit saying something different from Jakob, because I think that the evidence is pretty solid in the US, where you see a decline across a broad range of indicators. And I like to cite this Akshigit and Mattis paper showing the decline in business dynamism across 10 different indicators, and showing that it's a secular decline in the US that's seen through a range of indicators, so related to labor market, but also firm entry, labor shares, profitability, market power, and all these type of indicators. But when we look at the evidence across the Atlantic, I think the picture is much more mixed. And still, if you look at the same 10 indicators in the UK or in Europe, you see that, so I won't discuss all indicators, but you see that the picture is mixed, with some indicators having similar trends to what we observe in the US, but also some indicators having very different trends. So I can cite two of them. So I've had a paper with Herman Gutierrez in the past where we show that the decline in the labor share, which is a key indicator in the Akshigit and Mattis paper, wasn't observed in Europe to the extent that what we see in the US. And actually, if you look at the UK, if anything, the labor share slightly increased in the early 2000s. So quite different from what we observe in the US with this significant decline in the labor share. And that's actually also continuing since the start of the pandemic. I'll show you also a few slides later, and we were discussing this with Javier, that we also don't see a secular decline in entry rates in the UK, not like what we see in the US, but I guess it depends on what sample of firms we're focusing on. So I think figuring out what exactly are the trends in the UK is actually quite important, because I think the literature often assumes that this broad decline in business dynamism is common across all countries, and look for global explanations for this global decline in business dynamism. But I strongly believe that if doing more work and understanding the UK specificities, the European specificities, and how that differs from the US will help us pin down the exact drivers of the declining business dynamism and understand better what's related to global explanations in this decline versus what is related to more UK or country specificities, and help us design better policies to restart productivity growth in this country. So in the UK, though, the additional challenge, and that's something that we've been discussing quite a lot across this conference, is data. And I think this can be seen is in the fact that we don't even have a good picture yet of even big picture facts. And I think Chris Giles made this comment, I think it was yesterday or the day before, that we don't even know where productivity growth is and what's the big picture fact around productivity growth in the UK. And to just give you an example of that, so for a long time, we thought that the UK was worse than any other G7 countries with weak productivity growth and a stronger decline in productivity growth since the global financial crisis. But this has been revised in 2021 when the ONS introduced double deflation. And now the UK looks a lot more like other G7 economies. And actually, there's also forthcoming labor market revisions that will make the UK look even better than some other G7 economies in the near future. So we still don't have even a good picture of these big facts in the UK, and I think that's also an opportunity for research to help build these facts and understand better what's happening in the UK. So quite a great opportunity. So to build the facts around the secular decline in business dynamism, but also the most recent evolution. Because I think this is quite interesting because what we know of the most recent evolution, productivity growth in particular, is that the UK has been lagging the US alongside other European countries since the COVID pandemic. And it seems that more and more commentators, observers point to tech being one of the main reasons why we see a productivity revival in the US that we don't see in Europe and the UK. And actually, what I will show you today is that this tech revival we see in the US data, we see also in business creation data, and we don't see this business creation in tech in the UK, and so it's quite interesting. It would be interesting to do more research to understand why there is no more business creation in the UK in this tech sector, nothing like what we see in the US. So when I talk about business registration, I will explain a bit more what data we've been using and what I'm referring to. So the data we've been using more and more at the bank, and especially since the COVID pandemic, is the Companies House register data. So the benefit of this data is that it's real-time data, so we can track firm entry and dissolutions in real time. So Companies House is the registry of all incorporated entities. So any business wanting to incorporate and have a legal status different from their owner, and so open a bank account, for instance, will have to register with Companies House. So Companies House also tracks dissolutions, so we can have daily firm entry and exit within the Companies House data. So when firms incorporate, they don't necessarily need to employ workers. So this is quite a different measure of business creation than the US Census business formation statistics, because the US data covers applications for new employer businesses, and so only predict firm entry. This data, by contrast, is the entry of any incorporated entity. So a bit different from the US BFS. The benefit also of this data is that when a firm incorporates, it has to declare a lot of information about its activity. So it has to declare its location of the headquarters with a precise postcode, the main sector of activity. It also has to declare who owns the firm and all the stakes of the owners, as well as who directs the firm, so all the directorship information. And then we get, so we source this data from Bureau van Dijk, so Orbis, and then we can get the firm's balance sheet when they start declaring this balance sheet, so which is on average like 18 months after birth, although some firms might have exemptions depending on the size of the firm. So this is quite different from the ONS, Interdepartmental Business Register, so the IDBR, which is the ONS census, I would say, because the ONS data, the IDBR, captures firms once they are large enough to pay VAT, or once they're already employing worker and so show up in PAYE. So the way to make sense of these two data sets, so Companies House will be capturing firms at an earlier stage of their life cycle. And so once they're big enough to pay VAT, or once they employ people, they will show up as a firm entry in the IDBR. The IDBR, though, has a bigger, broader definition of firms. It doesn't only include incorporated businesses, but it also includes other type of unincorporated businesses. But usually, if you compare Companies House entry to IDBR entry, you see that Companies House entry is much larger than within the IDBR. And it usually leads the IDBR by a year. So it usually takes a year for a firm, after showing up in Companies House, as an entry in Companies House, to show up within the IDBR. So that's what we've shown in a paper with Salim Bahaj and Anthony Savagar. So here, I'm going to show you a few facts using Companies House data. And the first one using the historical data from Companies House. So Companies House was started in the mid-19th century. So, but here we have historical data available on their website from 1940. And we can track entry rates since 1940 in Companies House. And I also compared on the right with what we see in the IDBR, but the IDBR sample here, so from ONS website, the IDBR sample here only starts in the early 2000s. So different time periods. So if I start with a Companies House entry rate, so the blue line here, I also plotted the trend in the entry rate since the 1980s, which is usually the time period 1980s to now, the time period people use to document the decline in entry rates in the US. You see that in the UK, the red line, the trend since the 1980s, shows that there's been no decline in entry rates in Companies House at least. And if anything, entry rates have been increasing since the 1980s. If you focus on the more recent period, so since the early 2000s, you see that entry rates have been broadly flat. And this is quite consistent with what we see in the IDBR. So entry rates is the darker blue line. And we see that entry rate has been broadly flat as well in the IDBR since the early 2000s. So a different picture from what we usually have in mind when we think about the US data. So what happened in the most recent period, and I think this is actually quite an interesting fact that interesting facts we've been observing since COVID in terms of business creation, and probably why people work more and more with business creation data, is that in response to the COVID pandemic, we've seen a surge in business creation. And this was pretty surprising because usually business creation falls in times of crisis. So here, what you see is cumulative monthly business creation in reference to month 0 of a crisis for the global financial crisis relative to COVID on the right. And so what you can see is that during the global financial crisis, so the UK is the black line, monthly cumulative applications have fallen like significantly and then started to recover slowly, and was still very much below pre-crisis trend around a year within the crisis. But during COVID, you see that business creation fell during the first lockdown, but then rebounded such that a year within the crisis, business creation were still much higher than pre-trend, pre-COVID trend in the UK, but also in other countries. So you have the US in blue and France in green. So this is something we've seen across a range of OECD countries, and I think the OECD has a paper showing that this is common to even a broader range of countries, more than the 3 that we're showing here. So what is this business creation during the pandemic? Well, there's been quite a lot of research, and I will start with the research in the US on this. And so there is Ryan Decker and John Haltiwanger who did quite a series of papers trying to understand what is this surge in business creation. And in the most recent update of their work, they're showing that this surge in business creation was genuine. And by genuine, I mean it's actually translated in entry of firms and employee firms in particular. So it did translate into employer contributions of these firms being created in the BDS data, which is equivalent to the IDBR. They also show that not only business creation during COVID was related to activities very specific to COVID, like online retail, that surged during the pandemic because of the lockdown policies. But also there is a big aspect of business creation in high-tech, and we see, and actually this high-tech business creation has been quite persistent. So we still see, as of 2024, I think that's the latest data I've seen in their paper, we still see high entry rates in the tech sector. And that's been quite persistent, whereas the online retail was more short-lived. That's what we see in the UK. In the US, sorry. But what about the UK? Well, we have a paper again with Salim Bahaj and Anthony Savagar. We investigated what this business creation was in the UK, and it's actually quite a different picture from what we observe in the US. So we first find that the surge in business creation was not translated into employer businesses creation. So there's two ways we show that. The first way is that actually we don't see an increase in business creation in the IDBR, meaning that now we've seen, during the pandemic, we've seen a divergence between Companies House entry rates and the IDBR entry rates, because Companies House firms were actually very short-lived firms. And that the other way we show this, we show that firms that were creating during COVID in Companies House have a much lower survival rate. And so within 2 years, they tend to dissolve a lot more than firms that were born in previous cohorts, so before the pandemic. And so if you look at the entry rate in Companies House, but excluding firms that dissolve within 2 years, so very short-lived firms, you don't see a surge in business creation anymore. The entry rate is flat. And I have a figure showing this in just a few seconds. We also see a different industry composition of business creation relative to the US, as we see that most of it is concentrated in online retail only. So most of it was related to the pandemic and the response to the different lockdowns. And we don't see a persistent increase in entry rates in the tech sectors, so be it services tech or manufacturing tech sectors. So not like in the US. One thing we do also is that we exploit the fact that we have ownership information from Companies House, and so know who started the firms during COVID. And we identify individuals based on their prior experience of entrepreneurship. So we look at who started firms, and we check whether these individuals already started firms before or already own a firm when they start a new firm. And we find that firms starting during COVID were started by solo entrepreneurs, but most of them had little to no prior experience in entrepreneurship. So they were not serial entrepreneurs, and we find that this is actually the characteristic that best predicts the fact that these firms had limited employment creation. So a lot more so than the fact that these firms were in online retail. So ownership did, who started firm actually mattered to understand the contribution of these firms to employment. And the final thing I want to highlight as well is there's been quite a few newspaper articles about the fact that firm exit rates have been quite high recently. But actually, we show that these increase in exit rates reflects the existence of these short-lived firms, and it's really reflecting the fact that most of the firms creating during COVID are already exiting. And I'll show you this through this figure. So it shows, again, cumulative application in blue in Companies House relative to pre-pandemic trends. And the exit one is the orange line. And so you can see that we've seen excess entry during the pandemic, so a lot more entry relative to the pre-COVID trend. But also, since 2022, we've started to see excess exit. So we recompute these two lines, but this time, as I said, excluding those firms that dissolve within 2 years, so the short-lived firms. And so for entry, that's the black line. And you can see that if we exclude those short-lived firms, we see no increase in entry. And for the exit, that's a red line. And similarly, there is no excess exit once you exclude those firms that dissolve within 2 years. So quite a different pictures from what we've been observing in the US. And another way to show that is also entry rates in the IDBR. And so what you see in the IDBR, so these are entry rates, but also weighted by employment, so the employment contribution of entrants in the IDBR. So that's the blue line for entry rates, and so that you see the data from 2017 to 2024, and if you focus on the 2020-2021 period, you see no surge in business creation in the IDBR. So quite a divergence in between those two entry rates explained by the fact that business creation was only for very small firms that didn't have employment impacts. So I think to conclude, I'll just discuss a few research projects we're working on and also try to convince you that there's a lot more we can do with Companies House data, because it's quite unique data in the sense of its real-time aspect, but also the granular firm characteristics that we get, and in particular, the information we have on ownership and directorship, which seem to matter a lot to understand future firm performance. It's also very easily linkable to other data sets, and it's very linkable to the IDBR, given it uses the same Companies House registration number. So there's probably a lot more we could do to understand firm life cycle and understand when firms start to register in Companies House and then show up in the IDBR, and what are the predictor of firm growth. So we have a few projects we're working on at the bank. So the first one is we're really keen on using Companies House entry rates as a leading indicator of employment and GDP. And Anthony Savagar with Yanis Galanakis have a paper on this. But the problem is that during COVID, we saw that the surge in entry rates did not translate into GDP or employment impacts. So what John Haltiwanger did in the US is create an entry rate of high propensity business creation, so high propensity firms, by using the characteristics of firms when they register and predicting their growth potential based on their characteristics. And so it would be great that if we were to create such a series, so to have a meaningful measure of entry rates that is more related and leading to a leading indicator of employment impact rather than the Companies House raw data. So one thing we showed is that one of the great predictor of firm performance during COVID was the ownership of the firm and who started firms. And actually, this is something we could study in historical data. So the benefit of Companies House is that we have this ownership information since the 1990s, and so we have records of historical ownership and also directorship. So we can know who started firms in the 1980s for the universe of incorporations in the UK, so quite a unique data set. How this ownership changed over time within firms, but also across firms. And so what we're planning to do, so we have put together this data on historical ownership, and what we're trying to do is understand how who start firms matter for employment outcomes and firm performance, and in particular try to understand whether firms that are starting during recessions, there's this literature showing that firms starting during recessions tend to perform worse. So try to understand whether this is related to the composition of ownership of these firms and whether firms starting during recessions are started by entrepreneurs that tend to be related to less firm performance and firm growth. So see the composition of who start firms, how that changes over time in historical perspective, but also over business cycles. And finally, the last project we're looking at is IDBR. So the benefit of Companies House is that we have a lot of small firms that don't show up in the IDBR, but we have no real variables associated with these firms. So we've already linked the data to Indeed job vacancies, and now to understand whether these firms post job vacancies and have employment intentions. But we're also now linking the data to Experian credit data to try to also look at financial barriers to firm growth and study in more depth the dynamics of those very small firms. So I'll stop here.
Thank you. Thanks a lot for having me on this session. It has been a pleasure so far, discussing about colleagues, about the underlying sources of economic dynamism. So in this talk, I'm going to focus on some micro-founded data-rich evidence on the Netherlands, on how labor markets, innovation, policy and technology interact. And hopefully that increases our understanding of the underlying mechanisms of economic dynamism, the evolution of productivity and profitability. And this is joint work with my great co-authors in Amsterdam, Daniela Aglio, who is there, Erik Bartelsman, Anna Popovici, who is presenting in a parallel session, and Alessandro Sonamattioli from the UvA. So let me just set the scene by pointing to some motivating facts. We know that there has been a slowdown in productivity growth across OECD countries, and the benefits of this growth have been less equally shared, which can be seen on the panel A, and for the Netherlands specifically on the right panel. On top of that, we also see that Europe and the Netherlands have been lagging behind the US in terms of productivity growth and innovation. And this is especially due to discrepancies in the growth in the digital tech sector. At the same time, we see also that annual average wage growth has been on a decline, so following a similar evolution, but has been weaker than labor productivity growth. And this is especially true for low-wage workers. This has led to a decrease in the wage share, which is displayed here for the Netherlands, and has also contributed to rising wage inequality, as we can see, because the growth in the median wage has failed to keep up with the growth in the average wage. So growth has been less inclusive. This weaker growth in productivity and wages can be due to a decline in the growth within businesses due to, for example, changes in the pace of innovation, technology adoption, skill development, or it can be due to changes in how labor reallocates across firms. And that's exactly what we observe. We see a decrease in the job destruction rate in OECD countries and in the Netherlands as well. Now the question is, where is this decline in job destruction rate is coming from? Does it reflect like an increased cost of job reallocation on the part of employers who see weakening responses to firm employment in response to changing business conditions? Or is it reflecting barriers on the part of the workers moving employers? And that brings me to the fourth fact. We see a widespread use of non-compete agreements across OECD countries. On average, like 1/4 of workers are bound by NCAs in their contract, which could contribute to this increasing barriers to job mobility. And the last thing I want to introduce as a motivating fact is I will show that it's actually also the innovation policy levers that promote R&D throughout the life cycle of firms that could be an underlying cause of the decline in business dynamism. We've seen extensive use of input-based and output-based policy levers in many OECD countries, and the Netherlands is one of them. We had the WBSO, targeting reductions in the cost of hiring R&D workers, and we have the innovation box, which is basically increasing the after-tax returns to profits coming from innovation. So that calls, all these facts calls for research that tries to understand the interrelationship between market power, technology, labor, and policy. And in this talk, I'm going to address briefly 3 questions related to this broad research agenda. The first one is tackling the question, how are rents from innovation be shared between workers and firms, and how does the regulatory framework affect the sharing rule? The second question is, what if firms get a basket of money through government support to increase innovation? What do they do with the surplus coming from this innovation tax breaks? And the third one is we want to understand what the relative contribution is of technology, which is good for society, versus market power in product and labor markets in explaining firms' observed profitability. To do that, we need a firm worker, policy, data infrastructure. And over the past decade, we have been working quite intensively at our university to set up such a framework. We matched the microdata from CBS. We have the universe of workers and firms. We match that to policy data, like in innovation policy levers. We have also data on non-compete. We have data on individual level bargaining at a firm level between workers and firms, allowing us to look at the role of unions as a protection institution. We matched it to other data, patents, Prodcom, and then we structured and cleaned it. We have merged matched employer-employee panels, and we can look at average employment and other outcomes for firms over 2 decades, which allows us to answer this type of questions I will briefly touch up. So let me first talk about how innovation rents coming from intangible asset creation are shared between workers and firms, and what the role is that non-compete agreements play in this sharing rule. We started this question by looking at these empirical facts. What we do is we estimate for 2 decades of manufacturing and services, the wedge between wages and the marginal revenue product of labor, we call that labor market imperfection, and the wedge between the price and marginal cost, price-cost markups. And what we see for the Netherlands, with the circles being the two-digit industry averages and the size relative to the real value-added share, is that most firms, they pay wage markups, and they set price-cost markups. Then the question is, where does that co-movement come from? So what explains the co-movement between wage markups and price-cost markups? The answer is technology. It's coming from intangible assets. So what we show in the paper of Erik Bartelsman and Alessandro Zona-Mattioli is the following. I give you the core intuition. In our model, we have 2 types of firms. We have the safe sector firms that use a fixed technology, and they hire frictionlessly labor at the outside wage. Then we have the intangible asset using firms. We have 2 types of them. We have the innovating firms who co-create intangible assets with their workers. Once created, intangible assets, they generate innovation rents. But owing to limits in the enforceability of ownership rights and the non-rival nature of intangible assets, part of the rents can be kept by the original firm. That part is measured by retainability, the firm dimension. And part can be transferred to poaching firms by hiring away knowledgeable employees. That's what we call leakability. That's the worker dimension. And of course, such an environment that creates a hold-up problem. And the innovating firm is anticipating this hold-up risk for poaching. And what it does is it designs rent-sharing contracts to reduce poaching and to increase worker retention. So that's where the retention effect is coming to play. And higher rent sharing, so paying higher wage markups, protects intangible assets and makes poaching less attractive and increases worker retention. And there are 3 types of heterogeneity that affect the workers and firm decision in the model. It's the quality of the worker-firm match. It is the firm retainability, and it is the worker leakability. And here is how the mechanism works that drives the co-movement between price-cost markups and wage markups. Intangible assets, a higher Z, decreases marginal cost, increases price-cost markups. Intangible assets, their value increases with the stock, and therefore the original firm, the innovator, wants to protect the assets from being transferred to the competitors and designs rent-sharing contracts, wage markups. And we have a couple of predictions which we confirm and test with the microdata. And what is the role of NCAs? So what the NCAs are doing in their model is they impose a waiting time before a worker can start at the poaching firm. That lowers the flow profit for the poaching firm. That reduces the poaching risk. Therefore, rent sharing is reduced and worker mobility from innovators to poachers is reduced. A couple of measurement challenges in this paper. How do we measure the Z in tangible assets? Here we use expenditures on automation for firms, which are used to automate complex production processes and internal procedures related to software, databases, hardware technologies. The question is also how to measure retainability and leakability, worker leakability. In this paper, we measure to IP protection, the measure of firm retainability. I'm just gonna show you one result, namely the one related to NCAs, which I argue acts as increased and the cost of job reallocation on the part of the workers. What we see is that workers that are bound by NCAs in intangible intensive firms, they are paid less. Why is that? Because there is less need to share rents, the protection motive is decreased. What we also see using quasi-experimental evidence, what we do is we exploit the reform in the Dutch Worker and Security Act in 2015 in the Netherlands, which was aimed at creating a balance between the insiders, the highly protected workers, and the outsiders, the ones with a fixed employment contract who are not protected enough. What we see is that one of the ways that the reform works is through banning NCAs and fixed-term employment contracts. The treated workers in the post-treatment period see an increase in their pay. And this effect in the increased labor income is completely driven by workers bound by NCAs before 2015, working in an intangible intensive firm. This is consistent with the model prediction. So from that, we understand and we learn that increased cost of job reallocation could be due to increased barriers on the part of the workers moving to other employers. The second research I want to touch upon briefly is the work of Anna Popovici on how innovation policy and labor outcomes interact. In the Netherlands, as in 52% of the OECD countries, we have input-based innovation policy levers, which aim at increasing startup of innovation or scaling up of innovation in the short run. And we have IP and profit tax incentives, the innovation box, which is aimed at rewarding innovation, rewarding successful innovation. What we tackle in this question, in this paper, is the question: how do firms that get innovation tax breaks and see their profit from innovation increased, how do they allocate the surplus, and how does that affect the labor market outcomes? This question has not been addressed before in the literature, and this gives us insight on how innovation policy affects real activity through affecting labor market outcomes. There are two channels through which it can happen. It can work through a retention channel by paying your talented incumbent employees higher wages, or it can work through a worker adjustment channel through which the firm will hire talented workers to keep their sustained innovation. What we find in this paper is that treated incumbent workers, these are workers who were hired at least 3 periods before the firm got the innovation tax break. They see a 4% increase in their annual salary, which we interpret as rent sharing, which is aimed at increasing the retention of these talented incumbent workers who helped to create a successful innovation. The worker heterogeneity is immense. We find that educated STEM workers, they benefit 3 times as more. So that's evidence on the retention effect. So retention can be used as a way, rent sharing can be used as a way to increase retention. The second mechanism we find is the worker adjustment mechanism. First of all, treated firms who received innovation box, they have much higher survival rates, have an impact on the exit rates, on firm dynamics. And we see composition shifts post-treatment towards the high educated STEM workers. So that's the worker adjustment channel. So that type of research suggests that there could also be that the decline in job reallocation stems from innovation box effects that could increase the retention of incumbent workers and decrease exits. And the last paper I want to touch upon is the interaction between technology, market power, and labor market in explaining firms' profitability. There, the idea is very simple. If we think about what are the underlying drivers of firms' short-run profitability, well, it depends on the price that the firm sets for its product, and it depends on the wage that it pays for its workers. Very simply said, we have a nice stylized model which I can capture very well in this graph. So the price, how much the price is set above the marginal cost, that's determined by the degree of competition, the price cost markup. How much the marginal cost deviates from average variable cost is driven by technology, shaped by the elasticity of scale, the scalability of firms, and is shaped by firms' monopoly power. So we can decompose, we can trace the origin of firms' profitability, flow profits, and decompose it in the part coming from technology, the part coming from product market power, and the part coming from labor market power. And what we find, and to do that, what we do is we cluster firms according to 3 dimensions to allow for firm heterogeneity. We cluster them according to production technology, demand rigidity, and responsiveness of labor to wages, labor supply elasticities. These are the clusters, and what is very clear is that there is a trade-off for a firm between getting your profit from technology versus getting your profit from market power. On average, we find that the flow profit is over 2 decades, 30 percentage points. 60% is coming from technology, 27% from product market power, and 30% coming from labor market power. And the last very preliminary result I want to touch upon is the following. Can we use that framework to understand the weaker response of firms to, let's say, changing business conditions, such as productivity changes? Yes, we can. What we find is that firms that earn their profits from technology, they respond positively to productivity shocks in terms of positive responses in terms of revenue or employment. However, firms that earn mostly their profits from product market power or labor market power, well, these are the firms where we see that firm growth, either in revenue or in employment, is hindered once hit by productivity shocks. So we argue that this can solve part of the productivity puzzle. So in a nutshell, what I showed here is that we can look at and we can exploit rich data to understand the interaction between technology, market power, labor, and policy. I showed that rent sharing can serve as a retention motive, and that can affect, of course, mobility. And I showed that technology, as we knew, is a key driver of profitability, and especially if we use a model-based framework to trace the sources of firms' profitability, well, it's clear that firms that have a lot of product market power, these are the firms which also could be the ones that have weakening responses to employment and could be partly solving the productivity puzzle. Thank you.
Well, thank you very much to the organizers for adding me to this wonderful panel and my colleagues here. So I want to talk also about research in business dynamism. I'm going to talk about the research that I'm doing, pushing a little bit beyond the types of data sets that we've traditionally used. There's lots of colleagues and co-authors that are part of this work. They're all mentioned here. I'm at IWH now in Germany, but I'm also associated with ESCoE. So same set of motivating facts, broad decline in business dynamism. Thank you, Sophie, for that really nice introduction with some discrepancies. I think they're reconcilable. So I'm going to say broad declines in business dynamism. And of course, Europe is falling behind the US in terms of innovation and productivity growth. So I'm going to provide some evidence using what I'm going to call integrated data frameworks. So I'm going to show evidence on declining dynamism broadly across Europe using cross-country evidence from CompNet. I'll talk a little bit about a new data infrastructure called the microdata infrastructure as well. I've been very focused since moving to Europe on the labor market origins of high growth firms. And for this part of the talk, I'm going to be using linked employee data from Denmark. And finally, I want to talk about perceptions and misperceptions in regards to startups. So I'm very interested in understanding why there's in the performance difference between US and Europe. And I'm very focused on startups and why are there more startups being created in the US versus Europe. And focusing on perceptions and misperceptions of workers as regards startups is something that I think we need to pay attention to. And for that, we're going to be using survey experiments. So this is new types of data for me as well. So evidence of the decline in business dynamism, this is from the BDS. Sophie referenced some of these. And so you can see the broad decline for decades now. This is a secular decline in startup rates, in job reallocation rates, the share of activity associated with young firms. By the way, you do see, and again, Sophie has hinted at this a little bit, in the US, you see a little bit of an uptick in the last few years in regards to some of these measures of business dynamism. But broadly, you see this long trend decline. Okay? These are businesses with employees. So it's very different from the population of businesses that Sophie was highlighting, right? That is one of the strengths of the data that she has is that she's able to look at other parts of the population. Okay? Here, we're very much focusing on businesses with employees, businesses that generate jobs. There's many candidate explanations from this, and Sabien has also hinted at some of these. So of course, intangibles, market power, frictions in labor markets, something that we both care a lot about, I think. There's stories about changing demographics, of course. So these are all very active areas of research, and I'm going to argue we need richer microdata to get at mechanisms. If we want to move beyond these broad trends, we need richer microdata. And we also need a lot of linked microdata and other types of data instruments. This is the other point, motivating fact. Indeed, there's a decline in TFP growth. You see the uptick recently in the US, but Europe is falling behind. Okay? And so I'm also going to argue that there's similar trends across all our European economies, but performance is, as well as the US, by the way, but performance is different, right? So similar trends, ignore the latest uptick, but similar trends and different performance levels, right? So we need to understand why is it that some economies perform better than others, even though we might see similar trends. So some evidence from these integrated frameworks. This is cross-country evidence that I'm going to present. These are businesses with employees. So these are job reallocation rates. It's a measure of the jobs that are moving around firms in the economy. Okay, we're focusing here on the 20E sample. So it's quite different from the sample that Sophie was discussing and describing. What you see here is that reallocation rates have been going down across the board, across all European economies. You see the United Kingdom at the bottom. How do you think about the 20E sample? These are businesses that make it and grow to that size, through that size threshold. So very, very different from the type of businesses that Sophie was talking about, where there's a lot of froth, a lot of entry, a lot of quick exit, right? These are businesses that have a presence, that create employment, that create jobs, and you do see this very sharp decline in business dynamism, right? This is across the board, across all European economies. The UK stands out as one of the countries with the largest declines in business dynamism measured and seen through this particular lens. Okay, again, very different from the smaller size firms and non-employers. You've seen this in other sessions. The decline in reallocation and business dynamism is a within industry story, is a within firm size story, and is a within firm age story. Right? So business declines in business dynamism are taking place everywhere, across all geographies, all types of businesses, and across all types of industries. So this is not a composition effect. This is not driven by moving away from manufacturing. You see declines across all industries. Sabien has mentioned this point. You see it with these cross-country data frameworks as well. There has been a decline in the responsiveness of businesses to productivity shocks, right? Businesses respond to their environment, but over time, businesses have been slowing down their response to productivity shocks. Okay? This is true in Europe. You see for all the different economies, you see the United Kingdom over there with very strong, again, declines in responsiveness to productivity shocks. But you also see it in the US. So the US has experienced declines in responsiveness as well. So you see it in the manufacturing sector where we measured it with John. In the dashed vertical line, you see that the responsiveness in the US has also gone down, right? So very similar trends in terms of responsiveness of businesses to their environment, in terms of reallocation, as well as in terms of high growth firm activity, right? So similar experiences, right? If you maybe ignore what, again, to Sophie's point, what's been happening the last few years, why do some economies do better, right? Still the case that Europe is falling behind. It's just now, recently, we're falling behind even faster. But it is true that some economies do better than others, right? And that's what we need to understand. These cross-country microdata frameworks are useful because, of course, we can exploit cross-country variation in framework conditions, in policy levers to get a little bit deeper beyond the headlines, if you will. I'm going to talk very briefly about the microdata infrastructure. This is a microdata infrastructure that we're building at IWH, at IWH, together with colleagues at Freie Universität and Eric Bartelsman and the whole team over there. So what is this and what is going to allow us to do? This is a distributed research infrastructure. We're building an infrastructure that is going to allow researchers broadly to access the microdata, the gold standard microdata that's housed inside of statistical offices and execute code when they use our tools, this software infrastructure, execute code in one node that we're going to be able to execute throughout in other statistical offices, right? In other research nodes. Okay? So it's the first time that we're going to have comparable, we're going to have the ability to do cross-country data on the confidential gold standard data broadly for across European economies. Okay? We're developing the code, the node here in the UK together with ESCoE and the ONS, and it's already working. Okay? So we have active nodes in the UK, in Germany, in France, Finland, the Netherlands, Austria, Portugal, and we're expanding to Spain, Italy, Greece, and Malta. And so this network keeps growing. So the type of charts that I showed you before are things that researchers are going to be able to do themselves with the gold standard data. We're planning to open some of these nodes towards the end of the year, so stay tuned for that. Again, the goal is to make it accessible to the broader research community. Okay, so I want to switch a little bit. I mentioned earlier, I'm very focused on what's happening with startups and startup activity. And I'm very focused on labor markets and labor market frictions. So I want to talk about the use of linked employee data for some of these. And so I want to focus on what are the labor market origins of high growth activity and high growth formation. And the intuition here is very simple. This came to me when I moved to Germany, and I asked, big economies there were telling me, well, in Germany, startups don't matter. We don't need startups because we have BMW, right? And I said, well, okay, we'll see what happens. It also comes from talking to workers, and workers in Germany and engineers want to go work at BMW. They don't want to go work for a startup, right? And the intuition, right, is quite simple in this paper. So you're an engineer, right? You're a scientist, and you're deciding whether you want to go join a startup, which is a risky business, maybe doing very exciting work, maybe some breakthrough innovation, or you decide you can go work for BMW. Great product, great car, has been around, same car that has been around for many, 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 many decades. And you're going to be designing, right, gadgets and a new safety belt every year, right? Nothing terribly exciting necessarily. And whether you go to a startup or go for an incumbent large firm is going to depend, we argue, on the cost associated with losing your job. Right? So if you go to a startup, the likelihood is that you're going to lose that job because most startups fail. It's a very risky venture. Right? So the answer of whether you go work for BMW or you go work for a startup is going to depend on the cost associated with losing your job. Okay? So in this paper, we move beyond the traditional view, which is why we need the linked employee data, which is, entrepreneurs are the agents that take all the risk, they identify financing, and then they build it, and everything follows. Our insight in this paper is that workers also take risk, and they need, in fact, demand employment insurance. And so the insight of the paper is that if you lower the cost of becoming unemployed, then workers are going to be more willing to join startups. They're going to be willing to take the risk associated with those jobs. And so if you lower the cost of unemployment, then they will go. Okay? So the core insight of the paper is that innovation is not just about brave entrepreneurs. It's also about making workers comfortable with the risk that they're taking by joining a startup. Okay? I'm going to race through this because I have, I think, just a couple of minutes left. The story of this paper is very simple, and then I'll go to some of the results. If you lower the cost of unemployment, workers are going to feel safer. They're going to be willing to take a risky job in a startup. Startups are not going to have to pay such a high wage premium to attract these workers. And therefore, there's going to be more firms that experiment and that create innovative firms. We're going to build a model around these ideas, and we're going to run some experiments. And what are we going to find? We find that if you increase labor market fluidity, if you lower you can do this in this model by lowering the hiring cost, right? So if you increase the labor market fluidity, how quickly a worker who loses their job can find another job, then that's going to have an impact on the wage premia that these startups have to pay to attract these workers. Okay. So what are we going to find? If you increase the job finding rate by 10%, innovative firms are going to have to, we'll see a reduction in the wage premia that they have to pay to attract these workers of almost 85 basis points. By general equilibrium effects, you see that the wages of safe firms, whether they're young or mature, that follow safe business models or have established business models, the wage premia in those firms goes up by 20 basis points. Okay? This has implications then for experimentation. We see experimentation of entrants go up by 10%. So relatively small changes in wage premia have important impacts on experimentation in startups. We also see an increase in the share of young firm activity. Okay. Why linked employee data matters? Because you can separate the worker and firm components of pay. And so you can then interact with local labor market conditions to identify some of these levers. I have 1 minute left. I was going to talk about experimental surveys. I'm just simply going to say that if you talk to labor economists, they'll tell you that jobs are bundles of attributes, right? And so one of the attributes that I'm very keen in understanding, and also understanding how workers perceive these attributes, is job security. Right? And so we've done a survey experiment where we give workers choices about different jobs, jobs with different types of attributes, and we're able to estimate the willingness to pay that workers have for different types of attributes. Okay? And one of the most important attributes that workers consider when negotiating their wages is indeed job security. How secure is the job that you're taking, right? It turns out that matters, and it matters a lot. Let me go to, since I'm out of time, to some of the results from this research. We were expecting to see, so again, we were very interested in understanding the difference between Europe and the US. And so we've done this survey and in this experiment comparing US workers and German workers. So what do we find? Perhaps not surprisingly in hindsight, but it's not what we expected. Workers' preference around different job attributes are actually quite similar for workers in Germany and the US. So workers care, right, about job security everywhere, and in similar ways, not very different ways. We do find, however, that workers in Germany perceive the startup label a bit more negatively than the US. I'll say that a little bit of the surprise for us is that there's also a negative perception meaning workers demand some wage premium to go work for startups. So also in the US. The third thing that we find is that misperceptions about startups are a big driver of the differences across Germany and the US. So workers in Germany misperceive the bundle of attributes that they're going to find in a startup, which really sets startups in Europe against being able to perform and attract workers. Okay, I'm out of time. So just final thoughts, and the slide is missing, but that's okay, because I'm out of time. Final thoughts. We need, I'm going to argue, there's a lot of, we have a very active field of research, very dynamic changes. The economies are changing constantly, and we need more data to get at the underlying mechanisms. And so I'm going to argue cross-country data, integrated frameworks, linked employer-employee data to understand the role of labor markets, and digging even deeper, survey experiments to understand what are the underlying mechanisms that workers care about. So thank you very much.
We'll have a chance to dig into, where the priorities lie in the data side in a second, and there'll also be a chance for the audience to ask the panel some question. But let me maybe go back to something that both Sophie and Javi raised, which is this divergence since COVID in business creation in the UK versus the US. So to what extent does this divergence tell us anything about the underlying drivers, particularly for the UK? Is this an entry problem, a post-entry growth problem, or maybe something else entirely? Should we?
No, go for it.
Well, I mean, I'm not sure I have an answer to this question, unfortunately. And I think I totally agree with Javier that we have very limited cross-country comparison, microdata to do some cross-country comparisons, especially when it involves the US. So CompNet is really amazing for that. But it's very hard to always compare with what's happening in the US. But I think, so we really see this surge in business creation during COVID in high tech, well, since COVID in high tech in the US. But I think the productive growth in the tech sector has been going on for a bit longer than that. And that we haven't seen in the UK, despite the UK having a relatively larger share of the tech sector than other European economies. So the question is really, why are the tech companies in the UK not making as much productivity gains? And I think that's really what you've been repeating all over your presentation. It's the tech sector is also a big sector in the UK, so why are firms not performing as well as firms are performing in the US? The other point, I think, relative to this debate that I think is quite interesting and that probably adds to the puzzle is this whole discussion about how that translates into higher living standards. And this whole discussion about, in the US, we see much larger productivity gains in the tech sector. But if you look at the level of productivity today in the US and the UK, the relative level of the UK relative to the US, it hasn't diverged so much since the 90s. So how can it be possible that we have large productivity gains in the tech sector in the US and yet no increasing living standards relative to the UK, despite the UK lagging behind in terms of productivity growth? So quite an interesting puzzle with still many questions to answer.
Yeah, if I can, I mean, I think Sophie's research points the way, and she just mentioned it, right? It's not all startups are the same, right? And not all business formation is the same type of business formation. So we care a lot about businesses that create and bring about innovations, right? And what her research has showed in terms of the differences in the US and UK is that indeed that margin is very different in the US and the UK. And I think that's, and Europe in general. And I think that's one of the key insights, right? Productivity growth comes from innovations ultimately, and Europe is just falling behind. We're just not very good at it, it turns out. And the question is why? Why are we not good at creating innovations? And so I'm now very much focused on inventors as one of the primary drivers and inputs into the innovation process, and labor markets, right? Of course, as the competitive environment matters, and the environment that startups face competing with incumbents is very, very important. I don't think that's terribly different between the US and Europe. I think research still to be done. So why is it that the US is able to create startups that are innovative, whereas Europe is not quite as good at that?
Can I answer? Perhaps. I think this brings me to the kind of puzzle why it is that innovation gains are not translated into productivity gains. And I think an area which is still quite under research is the role of the readiness of workers to innovate. So this is also something which can be exploited if we match data sources. I am thinking about the PIAX adult skill survey. If we can match that to match employer-employee to learn what is the readiness to innovate of workers. And that also brings me to the next point, because this is the role of labor market institutions as well, right? So how can we ensure that our workers, also the ones who are older, that they keep on developing their skills, that they have the right skill sets to innovate, and that's where I think institutions come into play. We know that, for example, unionization is very important for firms, keeping up training, keeping up opportunities for workers to upgrade within the firms. So I think this is a margin which is still not too well understood.
Yes, I think this is a very good segue. So both Sabien and Javi, in your presentations and now mentioned sort of the people aspect of dynamism. And both of you, showed results from specific policies, that have consequences for business dynamism, sometimes unintended consequences. So I would just like to ask you to sort of step back a bit and say, in your view, what are sort of the biggest insights we have learned from bringing linked employer-employee data to the study of business dynamism, and sort of what are maybe the most understudied aspects of that match, for, I guess, junior researchers that are listening?
I think it's extremely important to bring the social safety net environment into research related to the role of market and business dynamics, especially the impact on worker outcomes. If I'm thinking about the effect on firm consolidation, on product labor markets, especially in the US, we know that this is like a source of product and labor market concentration. But even in Europe, and I'm talking about the Netherlands and specifically, there we see that firm consolidation can have negative impacts on labor market outcomes, even when there are mergers and acquisitions that are not harmful for the consumer because they are efficiency enhancing but not increasing prices. And that works to a labor structuring story. So even in the Netherlands, where we have like a rich social safety net environment, we see this heightened job loss in firms and workers in target firms. So this is an underestimate of a lower bound of the effect. So can I imagine that if we would do the same type of analysis in other countries where the social safety net is not that rich, we would have even much more worse labor market outcomes. That's one thing. So having more the social safety net environment integrated in this research, looking at the interplay between firm dynamics and labor market outcomes. And I think the second is also what I already mentioned, is the role of industrial relations. Especially we know that like demographic factors, the aging plays a big role also in this declining job destruction rate. So there I think we could exploit like the very nice data from Norway, where we can look at exogenous variation, neuron density rates to understand how skill decisions at the workplace, from the individual level at the workplace, how that matter. And this is especially important in an environment where technological and organizational change is so prevalent. So that's also something we need to understand better, the role of institutions, labor market institutions, industrial relations, and explaining that. And I think the third one is, of course, the role of NCAs. I think only recently there are papers trying to understand the role of NCAs on firm and worker outcomes jointly. We touched upon that in the intangible paper, where we see that NCAs, they reshape the bargaining conditions in favor of employers. This is a margin we need to understand better. And I think what would be especially important to think about is mobility constraints in a global value setting. So on the one hand, you can say that NCAs, they increase search and matching frictions and they lower mobility. But if workers were to be part of a production network, their search and matching frictions could decrease and mobility, job-to-job mobility could increase. So the interaction of the two would also be super interesting to look at, I think.
Yeah, I mean, I think one of the things that we clearly learned from this linked employee data is that that startups and entrepreneurs that want to build innovative enterprises face strong headwinds when they want to attract talent and attract workers. And so that's a big challenge. I think the other thing, related thing that we learn related to the industrial relations point is that incumbent firms are really attracting and consolidating large amounts of inventors, innovators, scientists, right? So these incumbent firms are very successful at attracting, especially these type of workers that you need to create new, to develop innovations, right? And so, by the way, what does this mean, right? These large incumbents are not particularly good at developing new radical innovations. They're good at what they created, not at new things, right? And so when they're sucking all these inventors to their large companies, right, through these wage mechanisms, competition mechanisms, then it becomes very, very difficult to generate jobs. The other thing that happens is that there's less mobility, right? And European markets are just not mobile. People are they're not very fluid markets. And so it becomes very difficult for technology to diffuse, right, across the economy. And so not surprisingly, you see this dispersion between an increasing gap between the incumbents in terms of productivity and the laggards. So we can gain strong insights from the linked employee data along all these dimensions. One thing that that Sabien, I think, rightly pointed to as well in the earlier answer, we are very much focused on, or I am very much focused on individuals, right? Individuals as workers that are part of the innovation process, but also as entrepreneurs and individuals that build enterprises, right? And in Europe, and some of what comes out of some of these surveys and experiments that we're doing is that the cultural differences and perceptions as regard entrepreneurship are very strikingly different between the US and Europe, right? And so this speaks also to culture and information treatments as to what it is the role of entrepreneurs in the economy.
Sophie, anything to add?
No.
That's fine. So before we open this up to question, I guess just a question on data infrastructure. So you've worked across different countries internationally. What do you think sort of in what areas is the existing UK data landscape particularly suited to study these questions, and where sort of is the gap with the international frontier the largest? Any order, I guess.
I mean, I think there's so I've worked with US data, I've worked with German data, I've worked with indirectly with Danish data. So all the kudos to my co-authors working with those data. And now I'm working with kind of data sets kind of across. I think there's strengths and differences, right? Strengths and weaknesses from the different data sets. I'll say in Europe, we have very rich administrative data that we would dream to have in the US, right? And I'll say it's also generally, it's easier to access than it is in the US. So in the US, accessing the confidential microdata is a 1.5 year proposition, and you cannot get away from that. In Europe, you submit a proposal to a statistical office and you get access in a few weeks, really. And so there's quite a bit of difference in that regard. I think there's differences in the different countries and to the depth of, in the level of how much integration has happened, and that matters. I think in the UK, we're making a lot of progress in linking a lot of different data sets, but I'll let others speak about the UK.
Yeah, so maybe I can say a bit. I think, so the UK has a lot of really cool alternative data sets to admin data, because I think historically admin data has been harder to access. So if you think about micro, small firms, so Companies House is quite amazing for that. With the ownership dimension, I don't think there are many countries where we have such historical and broad measure of who starts firms and who directs firms, and so that's quite cool data. And then we have all these alternative new data sets with job vacancy data. We can match with these firms, also like credit data, like the Experian. But when it comes to admin data, it gets a bit trickier. But there's been 2 amazing projects that have been presented throughout this conference. So one in a parallel session now, one yesterday at the session where we're starting to see some initiatives to have linked employer-employee or working to business data. Unfortunately, we still don't have access to this data, even at the Bank of England. So we're still working to access this. So there's a lot of new research questions we'll be able to investigate more in the line of what you've been working on. But that's where we've been really liking, I guess, in the UK to better understand and have a better picture of business dynamism. And the last thing is, I've been working a lot on my research over the years over comparing US evolutions to European evolutions, and it's been really a challenge to compare European evolutions relative to the US because of the lack of similar data sets. So there are comparable listed firms data, but listed firms is a very selected sample of firms. And if you look at Orbis, the US sample is very bad. And then you have the census, but I mean, it had to take my co-author to live for a long enough time in the US, and it's very restricted in terms of access, and we can't really merge. I mean, we can do similar facts between Europe and the US, but it would be really something that will help progress this literature, I think, and help also compare really the evolution across different indicators. If we had some microdata infrastructure where we could have within the CompNet initiative, for instance, have more insights from the US data. And that would be something that I think would really help progress all of the facts and our thinking around this question.
It's, I guess, a to-do for you to add.
To do it for me. Yeah. I mean, I'll say in Europe, we're fragmented, right? It's all these different national statistical offices, and of course, we can't combine this data. Data are highly confidential and have to reside. They're not allowed to leave the vaults of the statistical offices. So then, how you create this cross-country harmonized infrastructure it's not easy, right? So if as sole researcher trying to do this type of work, if they have to go, right, develop the infrastructure by themselves in these different countries, it would take them their lifetime, right? And a huge amount of money and different teams of researchers in every country. So that's one of the goals of this microdata infrastructure, is create this harmonized data that researchers can broadly access and execute code throughout the network. Interesting that you mentioned the US and whether the US can be part of this network. I've been asked this question quite a bit. I talked to folks over there. So I think for the US right now, at least, I don't see it in the cards. It's challenging. The environment right there is challenging enough right now. Canada, I think to your point, there's nothing that prevents us from expanding this network beyond Europe. And so Canada is a candidate that we are already talking to, and maybe the US at some point they'll be part of it. But I agree with you, that would be very important.
Excellent. Anything to add, or should we take some questions?
I think we can take questions.
Okay, so maybe 1 or 2 questions. 1, 2, yeah. Yes, I think Sarah will become the microphone. I think you might have to.
Here.
Can you hear me?
Yeah.
Yeah.
Okay, the AV people. Oh, okay, gosh. Okay. So thank you very much for the presentation. It's very interesting. I'm Gregor from the Department of Business and Trade. I'll be a bit cheeky and ask 2 questions. But so first one is, can we get some practical policy recommendations for improving business dynamism as a business department? So we've been looking at other different levers we could pull. So should we focus more on grants, subsidies, tax reliefs, procurement? What do you think? And I think on your point on questions about decreases in job reallocation rates, could some of that be explained by the rise in self-employment by any chance? Thank you.
And then let's do the second question too, and take them together. Yeah.
Okay. John Cooper from the Department of Science, Innovation, Technology. I was really interested, Sabien, in the R&D tax credit and R&D grant analysis, but I wasn't sure. I just wanted to know a bit more about that. Was it the increases in wages? Was it at that sort of proportionate level to the amount that they got from the grants and the tax credits? And were there any difference between like smaller and larger firms? And was this like causal evidence as opposed to sort of correlation? Thank you.
Maybe, Sabien, if you start with that, and then we broaden it out to policy first.
Yeah, thank you. So what I showed is our average effects, and what we definitely see, there is a lot of heterogeneity, and the largest effects are coming from the medium to the small-sized firms. So that in that sense, this is what I would have expected. So in this paper, we are looking at the impact of the innovation box, right? We have not looked at simultaneously at the impact of WBSO or the R&D yet. But that's the next step, obviously, because what we see in the worker adjustment channel, there is already like pre-treatment hiring coming that we observe for STEM and high-skilled workers. And our hunch is that this is probably where these innovation box users already are using this WBSO to hire talented skills in the first place to be on their innovation and profitability path. So I think it's very important to integrate into the analysis also the other innovation policy lever to understand where the real economic effects on the labor market, where they are coming from. Is it only the innovation box, or is it like a reinforcement effect coming through the input-based tax incentive? Extremely important to understand, I guess.
Policy levers, broadly?
So an obvious policy recommendation from the work that I presented is is increasing labor market fluidity, right? And the flexicurity model that we have in Denmark, to me, is it's an important model to follow. Unemployment insurance is important, but smart unemployment insurance is really, really, really important, because otherwise we're hindering the business formation and the creation of innovative firms. And so what's the flexicurity model? Give enterprises, employers, more flexibility in hiring and firing workers, right? So that facilitates fluidity across firms. It allows for better matches between workers and firms. At the same time, you want to provide job security, right? That was the whole point of one of my papers. But you can do that through smart active labor market policies, smart unemployment insurance, like they do in Denmark. So let's not hinder labor market fluidity and the movement of workers across firms. Let's create smart labor market policies. I think that would be really, really important. You mentioned self-employed workers and the decline in job reallocation, and kind of this ties into Sophie's research. So in the US for a long time, while we've seen declines in dynamism in businesses with employees, we've been seeing increases in dynamism, if you will, for non-employer, self-employed individuals, and so that we think is related to platforms, right? These platforms, and it's much easier to become a self-employed individual. Call it contract work. And so there's clearly a divergent trend between self-employment or solo entrepreneurs and businesses that create jobs, and this is why it matters, right? The population of businesses that you look at, and so that's the solo entrepreneur that is employed at a platform, Uber or whatever, right? That's a very different type of business than a high-tech growth potential business. And so where you look at the distribution, right, is important.
Yeah, perhaps adding to that, I think there is also a big role to play for educational and training, training policies. So the interplay between education policy and innovation policy is extremely important to get the right talented people on the right place, to be sure that innovation gains are translated into productivity gains. And as I mentioned before, I think training subsidies are also extremely important, especially in an environment with large changes in terms of technology, in terms of organizations, to keep up everyone, to keep on development skills, and especially targeted towards some subset of more vulnerable workers who have lower job mobility anyways. So I think this is very, very important. And also I think innovation policy has a role to play in easing capital frictions, right? I already alluded to the fact that this innovation box, perhaps, I think in the current literature, there as innovation box, they are mentioned for having IP profit location shifts. But I think the real economic effects in terms of labor markets has not yet very well understood. And at least what we show in this paper, that they can ensure that the firms stay on this innovation profitability path by easing financial frictions, which is, I guess, very important.
Last thought?
Super, super important. Completely agree in the connection between labor markets and financial frictions. We've been talking how startups really face headwinds attracting workers. The US solves this problem, I'm going to argue, through very deep financial capital markets and venture capital, right? And so that's still a little bit of a problem in Europe. So frictions in labor markets are a problem in Europe. Frictions in capital markets are a problem in Europe. And so these things are basic things that we need to address if we want to compete with the world.
good point to end on. So thanks to the panelists, thanks to everyone, and I'm sure we can continue these conversations over coffee.